Indonesia is hardly a classic investment haven. On top of its status as an emerging market, a segment struggling with slowing growth and rising debts, it's a commodity exporter just as commodity prices plunge. Yet amid the global turmoil, it's currently one of the top 5 best performing stock markets in the world this year, and it's also by far the biggest in that group. And one driver at the rally is that rarest of drivers, investor-friendly policy moves. But granted, not all is rosy. Corporate Indonesia's debt burden is rising, and a quarter of rated companies are currently holding negative outlooks, up from 10% in 2014, according to Moody's. Debt growth this year is also likely to match or outpace any earnings recovery. Also, that debt is mostly denominated in foreign currency, and the rupiah has duly wilted in the face of dollar strength. But much of this is already priced in. Companies facing downgrade are almost all junk rated already, meaning the risk should now be little surprise. Debt repayments only rise sharply in 2018 too, giving companies some breathing space. And as for dollar debt, according to analysts, many groups have either natural or financial hedges in place. Indonesians remember the Asian financial crisis very well. The catalyst for this year's rally appears to be the government. Earlier this month, the economy was shown to have been growing a little faster than expected, at a shade over 5%, and that helped. Now, on top of that, last week officials lifted some foreign investment restrictions. This was in sectors viewed as lucrative but previously blocked, such as healthcare and transport. This has prompted some economists to lift their growth forecasts on expectations there will be more inward investment. There is still caution. Earnings per share forecasts have slipped 0.7% in the past 2 months, but that is still a massive outperformance compared with the 4% cuts to hopes for Chinese and for Japanese companies, or the 9% drop in the profits Thai groups are expected to make. The Jakarta Composite's 6.7% gain this year doesn't sound that impressive, until you put it next to the 20% loss in Shanghai, the 13% in Tokyo, or the 8% in New York. And of the markets ahead of Indonesia in gains, Slovakia and Tunisia offer a combined 10 billion in market capitalization, while Venezuela is a market only for the courageous. Indonesian companies may be no haven, but they are worth a closer look.